Have you ever wondered how governments build, massive new infrastructure projects, or how major corporations finance their sprawling operations beyond just selling stocks? Well, today we're taking a deep dive into the powerful, sometimes kind of hidden world of debt instruments to reveal exactly that. Welcome to the deep dive. Our mission. It's really to give you a shortcut to becoming truly well-informed about complex topics. And this session is all about bonds and other lending mechanisms. We've gone through the sources to pull out the most important nuggets of knowledge for you. We're here to clarify this often complex financial landscape, maybe unveil some surprising facts, and hopefully provide those aha moments about how the financial world really functions. This deep dive is custom tailored, really, to help you understand what's most important in the sources we've explored. So let's start with the fundamental distinction. When an entity, could be a government, could be a corporation, needs capital, they essentially have two main paths, right? They can sell an ownership interest, it's equities or stocks, or they can borrow money.
And when they borrow, they're typically issuing what we call debt instruments, like bonds. When you buy a bond, you're not becoming a part owner. Instead, you actually become a creditor. You're lending money to the issuer for a specific period. In return, the issuer agrees to pay you regular interest and then, repay your original loan amount when the bond matures.
Okay, let's unpack this a bit. Before we dive into all the specific types of bonds, what's the core concept that really unites all these different debt instruments?
That's a great starting point. What's fascinating here is that at their heart, all debt instruments are basically just a loan. It's a contract between a borrower, the issuer, and a lender, who's the investor. Simple as that. But the magic and the complexity really comes in how these contracts differ. They primarily vary in their safety profiles, how they pay you back, and especially the tax status of their interest payments. And that then creates distinct opportunities for different investors.
Right, right. So the safety aspect, here's where it gets really interesting. If safety is your absolute top priority in the world of bonds, where do investors typically look first?
Without a doubt, you'd look to U.S. government securities, treasuries. Our sources make it really clear these are considered the safest type of fixed income investment out there, period. They're backed by what's called the full faith and credit of the U.S. government. That means there's virtually no credit risk, no chance of default, essentially. This unparalleled safety status is the ultimate benchmark. Everything else gets measured against it. And the U.S. government issues these primarily to finance its operations, pay its bills.
And we're talking about the ones you can actually buy and sell.
Yeah.
Not just like savings bonds you stick in a drawer.
Exactly. Yeah, we're focusing on marketable treasuries, the ones traded in the secondary market after they're issued. So that includes treasury bills, notes, bonds, and some specialized instruments like tips and strips.
Okay, let's start with the ones that pay interest. Treasury notes, T-notes, and treasury bonds, T-bonds. How do these work for an investor typically?
Right. These are your classic fixed income investments. They pay a fixed rate of interest every 6 months semi-annually. And then when the bond matures, you get your original investment back, your principal. T-notes, they have initial maturities ranging from 2 to 10 years. T-bonds are the longer-term ones, more than 10 years. They're issued electronically now, book entry form, and you can buy them in relatively small amounts, like $100 minimums, though you often see $1,000 used in examples. Makes them accessible. And a really significant advantage for investors is the tax treatment, the interest you earn. It's subject to federal tax, yes, but it's completely exempt from state and local taxation. That can be a big deal depending on where you live.
Okay, that tax part is interesting. So what does all this mean for investors who are maybe really concerned about inflation eating away at their returns over time? Is there something for that?
Yes, absolutely. That's precisely where Treasury inflation-protected securities, or TIPS, come in. They're incredibly valuable for that specific concern. With TIPS, the interest rate itself is fixed, but the principal amount, the actual base value your interest is calculated on, that adjusts based on changes in the Consumer Price Index, the CPI. So if there's inflation, your principal value increases. And your interest payments, because they're a percentage of that now higher principal, go up too. If there's deflation, the principal decreases, though it won't fall below the original $1,000 face value. So there's some protection there too.
Can you give us a quick example? How does that principal adjustment actually play out in practice?
Sure thing. Our sources give this great illustration. Imagine you bought a 4% TPS, original principal value, $1,000. Now let's say inflation causes that principal to adjust up to, $1,030. Your next semi-annual interest payment wouldn't be just $20, which is half of 4% of the original $1,000. Instead, it would be $20.60, because that 4% coupon rate is now applied to the adjusted principal of $1,030. You see?
Okay, got it. The payment itself changes because the base changed.
Exactly. And just like other treasuries, the interest from TPS is federally taxable, but still state and local tax exempt.
Okay, so we've got bonds that pay interest,
hmm
some that even adjust for inflation. But you mentioned treasury bills. It sounds a bit counterintuitive, a bond that doesn't pay interest. How does that even work? Why would someone buy that?
Yeah, it does sound a bit odd at first. You're referring to non-interest bearing treasuries, specifically treasury bills or T-bills. These are short-term securities, usually maturing in 1 year or less. Very common are like 1 month, 3 months, 6 months. The key is how they're sold. They're sold at a discount from their face value, so you don't get regular interest checks. Instead, your interest, your return, comes from the difference between what you pay for the T-bill, that discounted price, and its full face value when it matures. It's like you might buy a $1,000 T-bill today for, say, $980. In 6 months, it matures and you get the full $1,000 back. That $20 difference, that's your interest earned.
Okay, so you just pay less up front. But then how do you even talk about the yield on something like that if there's no explicit interest rate?
Right. T-bills are unique in how they're quoted, too. They're quoted on what's called a discounted yield basis. It basically represents the percentage discount from their face value annualized. Now, this can sometimes be a bit tricky to compare directly to, say, a T-note that pays interest. So there's also something called the bond equivalent yield, or BEY. It's a calculation that lets investors compare T-bill yields more directly to interest-bearing securities, and the BAY is always a bit higher than the simple discount yield because it reflects the return on the actual amount you invested, not just the face value.
Interesting. Okay. And beyond these main types, there are some specialized treasuries you mentioned, strips and CMBs. Can you shed some light on those?
Absolutely. Treasury strips are pretty fascinating, actually. STRIP stands for Separate Trading of Registered Interest and Principal of Securities. What happens is dealers basically take a regular T-note or T-bond and they strip apart all the individual interest payments and the final principal payment. They then repackage each of these separate payments as individual zero-coupon bonds. So instead of one bond paying interest every 6 months, you might just buy a strip that only gives you, say, the interest payment due 5 years from now, or maybe just the final principal payment 10 years out.
Ah, so you're buying just one specific future payment.
Exactly. And the crucial point is that strips are still backed by the full faith and credit of the U.S. Treasury, making them very safe, zero-coupon options. This is important because it contrasts with some older products like Treasury receipts or TRs, which were typically backed only by the broker-dealer who created them, not directly by the Treasury itself, so less secure. As for cash management bills, or CMBs, think of these as very short-term, unscheduled IOUs from the Treasury. They use them to manage temporary cash flow needs, maybe smooth things out between tax receipts and spending. Durations can be super short, sometimes just a few days, even 1 day.
Wow, okay. It sounds like the government is running a very sophisticated financial operation here. How exactly does one even buy these treasuries when they're first issued? You mentioned auctions. Imagine buying government bond like you're in some high-stakes bidding war, but with a unique twist.
Huh. Well, maybe not quite that dramatic, but it is a very organized process. It happens through treasury auctions in the primary market. Large financial firms, dealers, they submit competitive tenders or bids. That means they specify the exact price and yield they're willing to accept. Individuals, on the other hand, usually submit non-competitive tenders. You don't specify a price, you just say how much you want to buy, and you're guaranteed to have your order filled at whatever the auction price turns out to be. And here's that twist you mentioned. It's a single price auction. All successful bidders, both the competitive ones whose bids were accepted and all the non-competitive bidders, ultimately pay the same price. And that price is the lowest price of the accepted competitive tenders.
Ah, so it's a single price for everyone who wins a bid in that auction. That sounds efficient and fair, maybe.
Exactly. This single price auction process, it's known as a Dutch auction, and it's seen as a fascinating and efficient way for the government to ensure fairness, transparency, and maximize its borrowing efficiency by discovering the best market price at that moment.
Okay, interesting. Now, moving a step beyond the direct U.S. government promise, we encounter agency securities. What makes these different, but still appealing to investors, especially if they're not directly backed by the Treasury?
Right, agency securities. These include debt instruments issued or guaranteed by federal agencies and also by what are called government-sponsored enterprises, or GSEs. Now, while most might not carry that explicit direct backing of the U.S. government that treasuries do, their credit risk is still considered very, very low. There's just a strong market presumption, really, that the federal government wouldn't let one of these major entities default. They'd likely step in if needed. So this perceived safety, combined with the fact they often offer slightly higher yields than comparable U.S. Treasury securities, makes them quite attractive to many investors looking for a bit more return without taking on huge risk.
Got it. So almost as safe, but maybe not quite the absolute top tier. And are all agency securities backed in the same way then?
Not quite, and that's a really important distinction to make. You have true federal agencies, like the Government National Mortgage Association, GNMA, or Ginnie Mae. It's actually part of the government within HUD. Securities issued by Ginnie Mae are explicitly backed by the full faith and credit of the U.S. government, just like treasuries. Then you have the government-sponsored enterprises, the GSEs. Think federal farm credit banks, FFCBs, or Federal Home Loan Banks, FHLBs. These are publicly chartered, but they're technically privately owned organizations. They were created to help provide low-cost loans to specific sectors like farmers or savings and loans. Their securities don't have that direct government guarantee. But because of their mission and close ties to government policy, they still carry minimal default risk in the market's view. It's also worth noting, for example, that interest on securities from the FFCBs and FHLBs is subject to federal tax, but generally exempt from state and local taxes, similar to many treasuries.
Okay. And a huge part of the agency market, one I think many people have actually heard of, involves mortgage-backed securities, or MBS. What exactly are these, and how do they work? Sounds complicated.
Well, they can be, but the basic idea is fairly straightforward. MBS are debt instruments secured by pools of home mortgages. The key issuers here are Ginnie Mae, which we just mentioned, but also Fannie Mae, FNMA, and Freddie Mac, FHLMC. They create what are called pass-through certificates. Essentially, these agencies buy up thousands of individual home mortgages from banks and lenders. They bundle these mortgages together into a large pool, and then they sell interests or shares in that pool to investors. As homeowners make their monthly mortgage payments, both principal and interest, a portion of those payments is collected and then passed through to the investors who own the MBS certificates.
Okay, that makes sense. So you're basically buying a slice of a giant pool of mortgage payments. But how do those different issuers, Ginnie, Fannie, Freddie, compare in terms of security for the investor?
That's a crucial question. Ginnie Mae, as we said, is a wholly owned government corporation. Its securities are explicitly backed by the full faith and credit of the U.S. government. Ginnie Mae actually guarantees the timely payment of principal and interest to the certificate owners, even if the homeowners haven't paid on time. So, very secure. However, interest on Ginnie Mae securities is fully taxable federal, state, and local. No tax break there. Fannie Mae and Freddie Mac, on the other hand, are the GSEs. Fannie Mae raises money to buy various types of mortgages. It's backed by its own credit and its authority to borrow from the U.S. Treasury if needed. Freddie Mac provides funds primarily for conventional mortgages, helping create a secondary market. It's not directly backed by the U.S. government either. It's backed by its own corporate credit and the mortgages it purchases. And interest on both Fannie Mae and Freddie Mac securities is also fully taxable.
So definitely a spectrum of backing there, from direct government guarantee to more of an implied one.
Yeah.
But I've heard that MBS have a unique kind of risk, something not really present in regular bonds. What is prepayment risk?
Yes, prepayment risk. It's indeed a unique and significant risk for MBS, and really any asset-backed security where the underlying loans can be paid off early. It's tied directly to homeowners paying off their mortgages ahead of schedule. Why would they do that? Most often, it's because interest rates have fallen significantly since they took out their mortgage. Lower rates incentivize them to refinance into a new, cheaper mortgage. When they refinance, the old mortgage gets paid off completely. That principal repayment flows through immediately to the MBS investors. So investors get their money back much faster than they anticipated, precisely at a time when interest rates are low. Now they have to reinvest that principal at those lower prevailing rates, which can definitely hurt their expected overall return.
Wow, okay. That really highlights how, even with agency securities offering perceived safety, you absolutely have to understand the specific nature of their backing and these unique risks like prepayment. It clearly distinguishes them from direct treasuries.
Exactly. It impacts their suitability for different investors and different market conditions.
Right. Okay, now let's talk about bonds that quite literally hit closer to home. The ones that fund your local schools, bridges, maybe hospitals. And here's where a major tax advantage often comes into play for investors.
Yes. We're diving into the world of municipal bonds, often just called munis. These are issued by states, territories, and all sorts of political subdivisions, think counties, cities, school districts, and also various public agencies like water authorities or transit systems. Now, unlike U.S. Treasuries, munis do carry some level of default risk because they're not backed by the federal government. The issuer's financial health matters. But for many investors, their primary advantage is significant. The interest income received is typically exempt from federal income tax, and often there's a bonus. If you buy a muni issued by your own state or locality, the interest is frequently exempt from state and local taxes, too. This double tax exemption is why many investors prefer to buy in-state munis.
Okay, that federal tax exemption is huge. So what are the main types of municipal bonds? How do they differ in terms of how they're actually repaid? Who's guaranteeing the payment?
Good question. Primarily, there are two main types: general obligation bonds, usually called JO bonds, and revenue bonds. JO bonds are secured by the full faith, credit, and taxing power of the issuer. This is key. It means the issuer can, and promises to, use its general taxing authority to pay back the bondholders. Because of this, only governments with actual taxing power, states or local governments like cities and counties, can issue JOGO bonds. And since taxpayer money is ultimately on the line, issuing JOGO bonds typically requires voter approval. They're also usually subject to statutory or constitutional debt limits. Where does the money come from? Well, state GOs are often backed by broad taxes like income or sales tax. Local GOs tend to rely more on property taxes, ad valorem taxes, and maybe other non-tax revenues like parking fees.
Okay, so JOGO bonds are backed by the government's power to tax. What about revenue bonds then? Sounds like they must be repaid in a very different way.
They absolutely are. Revenue bonds are issued to finance specific projects or facilities. Think a new toll bridge, a water treatment plant, a university dormitory, maybe a hospital wing. And they are repaid using only the revenues generated by that specific project. The tolls from the bridge, the water usage fees, the dorm rents, the patient fees from the hospital wing. Because they're not backed by general taxes, they usually don't require voter approval. However, they do typically require a feasibility study done by outside experts like engineers and accountants. This study assesses whether the project is likely to generate enough revenue to actually cover the bond payments. Because repayment depends solely on the project's success, they're generally considered riskier than GO bonds. Project revenues can be unreliable, maybe lower than projected, or just insufficient.
So if you invest in a revenue bond for, say, a new toll road, you're literally betting on how many cars are going to drive on it.
That's a perfect way to put it. You are betting on the success and revenue stream of that specific enterprise.
Can you give us a sense of the kinds of projects these revenue bonds typically fund? It sounds pretty diverse.
Oh, it's incredibly diverse. Common examples include bonds for public housing projects, university dormitories, healthcare facilities, public utilities like power or water systems, and transportation infrastructure, airports, bridges, tunnels, mass transit. You also see things like special tax bonds, which are backed by specific excise taxes, maybe on tobacco or gasoline dedicated to a certain purpose, or special assessment bonds, paid for by charges levied only on those properties that directly benefit from an improvement, like new sewers or sidewalks. There are also lease rental bonds, often used for things like schools or government buildings. And then there are some interesting variations. You might hear about moral obligation bonds. These are a type of revenue bond where the state or municipality has a moral commitment, but importantly, not a legal requirement, to provide funds if the project revenues fall short. It usually requires legislative approval each time, so it's riskier than a GO. And you also have double-barreled bonds. These are kind of a hybrid. They're backed primarily by a specific revenue source, like a revenue bond, but they also carry the full faith and credit taxing power pledge of a GRAO issuer. That second backing makes them generally safer than a pure revenue bond.
Wow, lots of flavors there. Now that tax-exempt status is clearly a huge draw for munis, but can they ever lose that? Can municipal bonds become taxable?
Yes, they absolutely can. Municipal bonds might lose their federal tax exemption if the proceeds are used to finance projects that don't primarily serve a significant public benefit. Classic examples would be things like building a new stadium for a professional sports team, or maybe financing certain types of private business activities within the municipality, or even covering unfunded pension liabilities in some cases. When a muni bond is taxable, the interest income becomes fully taxable at the federal, state, and local levels, just like interest from a corporate bond.
Okay, that makes sense. Now, beyond these longer-term municipal bonds, what about the really short-term stuff? Do municipalities issue short-term notes like the Treasury does with T-bills?
They do. Municipalities issue various shorter-term instruments, often just called municipal notes. These are generally interest-bearing, with the interest paid at maturity rather than being sold at a discount like T-bills. They're used for temporary financing needs, managing cash flow gaps, or providing interim funding for projects. You see different types based on what revenue is anticipated. Tax anticipation notes, or TANs, are issued expecting future property tax collections. Revenue anticipation notes, RANs, expect other revenues like state aid or federal grants. Sometimes you see TRANs, combining both. There are also bond anticipation notes, or BANs. These provide short-term funding for a capital project that will eventually be financed by a larger, long-term bond issue once that's ready to go. And these notes even have their own short-term rating systems from agencies like Moody's and S&P, indicating their credit quality.
Gotcha. And what about things like auction rate securities and variable rate demand obligations? They sound a bit more complex.
They are a bit more complex, yes. Auction rate securities, or ARSs, are technically long-term instruments, maybe with 20 or 30-year maturities on paper, but they have a short-term feature. Their interest rates are reset very frequently, often every 7, 28, or 35 days through a Dutch auction process, similar to how treasuries are sometimes sold. They were designed for investors seeking potentially higher yields than typical money market funds, but with, theoretically, frequent access to their money via those auctions. Though that market did face significant issues. Variable rate demand obligations, or VRDOs, are also long-term securities on paper, but their interest rates also adjust periodically, maybe weekly or monthly. The key feature of a VRDO is that the owner has the right to put or sell back the security to the issuer or a designated agent at par value, plus accrued interest, on these rate reset dates. This put feature provides a significant liquidity option for the investor.
Okay, so lots of different ways munis get financed. How does a municipality actually issue these bonds in the first place? Is it similar to how the Treasury auctions off its debt?
There are similarities, but also some key differences that really reflect the unique nature of state and local government finance. First off, like treasuries, municipal bonds are generally exempt from SEC registration under the Securities Act of 1933. But they are regulated by a specific body, the Municipal Securities Rulemaking Board, or MSRB, which sets rules for dealers. When issuing bonds, the process differs. For GO bonds, as we mentioned, voter approval is usually required, and the issuer must adhere to legal debt limits. Revenue bonds, on the other hand, don't need voter approval, but they do require that crucial feasibility study to demonstrate the project's viability. In both cases, investment bankers play a vital role as underwriters. They assist the municipality in structuring the deal, pricing the bonds, and preparing the official statement, which is the primary disclosure document for potential investors, kind of like a prospectus.
And how do the municipalities actually choose these underwriters? Is it always just picking the lowest bidder, or?
There are actually two main methods for selecting the underwriter or underwriting team. One is a negotiated sale. Here, the issuer selects a lead underwriter or underwriting team up front, and then works directly with them to structure and price the deal. This method is very common for municipal revenue bonds, especially complex ones, where the issuer wants specific expertise. The other method is a competitive sale. In this case, the municipality invites underwriting syndicates, which are groups of broker-dealers who band together to bid to submit sealed bids. The syndicate that offers the lowest net interest cost to the municipality wins the right to buy the bonds and resell them to the public. This competitive bidding process is typically used for municipal general obligation bonds, where the structure might be more standardized. And these underwriting syndicates, whether chosen through negotiation or competition, share the liability and the risk of selling the bonds, usually on what's called a firm commitment basis, meaning they guarantee to buy the entire issue from the municipality.
That's really interesting.
Yeah, and if we kind of connect this back to the bigger picture, the whole underwriting process for municipal bonds, with its unique blend of things like voter approval requirements for GOs, the essential feasibility studies for revenue bonds, and then these competitive or negotiated sales methods, it really reflects that careful balance municipalities strike between public accountability on one side and trying to efficiently finance these crucial community projects on the other.
Right. That makes a lot of sense.
Yeah.
Okay, let's shift gears now. Let's talk about how companies, corporations raise big money without selling off pieces of the company itself. What are the key pros and cons for a corporation choosing to issue bonds instead of, selling more stock?
Sure. Corporations use bond proceeds for all sorts of things: building new factories, buying expensive equipment, funding research and development, maybe acquiring another company, general business expansion. For the corporation itself, a big advantage of issuing bonds compared to stock is that they don't give up any control. Bondholders aren't owners, they don't get voting rights. Also, the company doesn't have to share its profits with bondholders in the same way it might with stockholders through dividends. Interest payments are a fixed expense. The main disadvantage, of course, is that debt has to be repaid. The borrowed principal plus all the scheduled interest payments are legal obligations. Failure to pay can lead to bankruptcy. From an investor's viewpoint, corporate bonds generally carry less risk than common stock from the same company. Why? Because in a bankruptcy scenario, bondholders have a higher claim on the company's assets than stockholders do. However, the flip side is that bonds typically offer less potential for high capital appreciation compared to stocks, which can grow significantly if the company does well.
Okay, you mentioned bondholders have a higher claim in bankruptcy. Can you elaborate on that a bit? And what are the main categories of corporate bonds in terms of how secure they are for the investor?
Absolutely. In a bankruptcy liquidation, there is a pecking order for repayment. Bondholders and other creditors get paid from any remaining assets before stockholders get anything. Stockholders are last in line. Now, within corporate bonds themselves, they generally fall into two main categories based on security: secured bonds and unsecured bonds. Secured bonds are backed by a pledge of specific corporate assets. This provides a higher level of protection for the investor if the company defaults, because those pledged assets can be sold to repay the bondholders. Examples include mortgage bonds, which are secured by a lien on real property like land or buildings. There can be first mortgage bonds, second mortgage bonds, etc. Then you have equipment trust certificates, often used by railroads or airlines. These are secured by specific pieces of equipment like locomotives, rail cars, or airplanes. Usually, a trustee holds the legal title to the equipment until the bonds are paid off. And there are collateral trust bonds. These are secured not by physical assets, but by financial assets, typically stocks or bonds of other issuers that the corporation owns, which are placed in escrow with a trustee.
Got it. What about asset-backed securities, or ABS, in the corporate world? Are they similar to the mortgage-backed securities we talked about earlier?
Yes, very similar in concept. Asset-backed securities, ABS, are a significant and actually quite large part of the secured bond market now. They're created by pooling various types of loans, things like credit card receivables, auto loans, home equity loans, even student loans, and then selling securities backed by the cash flows from those loan pools. So just like with MBS, investors in ABS receive payments that reflect both interest and principal repayments from the underlying borrowers. The potential benefits for investors can include relatively high yields compared to other bonds of similar credit quality, diversification, and potentially predictable cash flow streams. But, and this is important, they also carry similar risks to MBS. There's interest rate risk, of course. There's credit risk if the underlying borrowers default. And notably, there's prepayment risk again. If consumers pay off their credit cards or auto loans early, investors get their principal back sooner than expected, likely when reinvestment rates are lower.
Right, that prepayment risk seems to pop up whenever loans are pooled. Okay, so that's secured bonds. What about the unsecured side? What does it mean for a corporate bond to be unsecured? What's backing it then?
That's right. On the unsecured side, you primarily have what are called debentures. These bonds are backed only by the corporation's general creditworthiness and its promise to pay its full faith and credit, as they say. There are no specific assets pledged as collateral. So the company defaults. Owners of debentures have the same claim on the company's assets as other general unsecured creditors. They stand in line after secured bondholders, but before stockholders. Within debentures, you can also have subordinated debentures. These have an even lower priority claim than regular debentures, meaning they only get paid in bankruptcy after all other debt, including senior debentures, has been satisfied. Because they're riskier, they offer higher yields. You've probably also heard of high-yield bonds, often called junk bonds. These are simply corporate bonds, could be secured or unsecured, that are rated below investment grade by the rating agencies, like below BBB by S&P or BA by Moody's. This lower rating signifies a higher perceived credit risk, a greater chance of default. And because of that elevated risk, these bonds typically have to pay significantly higher coupons or interest rates to attract investors. And one other type worth mentioning is guaranteed bonds. These are bonds issued by one corporation, maybe a subsidiary, but their payment is additionally guaranteed by another corporation, typically the parent company. That guarantee enhances the bond safety based on the creditworthiness of the guarantor.
Okay. Are there any other, maybe more niche or specialized corporate bond types that stand out? Maybe related to international markets or unusual situations?
Yeah, there are a few interesting ones. Income bonds, for instance, are quite unique and quite risky. They're usually issued by companies that are actually going through reorganization, often emerging from bankruptcy. The company promises to repay the principal amount at maturity, but, and this is the catch, Interest payments are only made if the company has sufficient earnings to do so. If earnings aren't there, they can skip the interest payment without triggering a default. So, highly speculative. On the international front, you see several key types. Eurodollar bonds are bonds denominated in US dollars but issued and traded outside the United States, often in Europe. They escape SEC registration. Yankee bonds are the opposite in a way. They allow foreign governments or corporations to borrow money in the U.S. marketplace denominated in U.S. dollars. These are registered with the SEC. And then a Eurobond, more generally, is a bond sold in one country but denominated in the currency of another country. So, for example, a Russian manufacturer might sell bonds denominated in Swiss francs but issue and sell them primarily in London.
Wow, that's a lot to keep track of.
It is. And, this really raises an important strategic question for companies. How do they weigh those advantages of issuing bonds, like retaining control and not diluting ownership against that fixed obligation of debt repayment, especially when they're considering this whole range of options from secured versus unsecured, maybe high yield, or even tapping into those complex international markets? It's a big decision.
Definitely seems like it. Okay, so we've explored a lot of longer-term loans, from treasuries out to 30 years, corporate bonds. But what about the really, really short-term stuff, the things sometimes called cash equivalents that keep the daily global economy humming, often kind of behind the scenes?
Ah, yes, that brings us perfectly to the money market. You're right, this isn't about long-term borrowing. The money market deals with debt securities that have very short maturities, typically 1 year or less. And they're often called cash equivalents precisely because they tend to be very high quality, very safe, and highly liquid, meaning they can be easily bought or sold, or they mature very quickly, turning back into cash. The core purpose of the money market is to provide a place for institutions, governments, banks, corporations, money market mutual funds to park temporary excess cash safely and earn some interest, or, conversely, to borrow funds to meet very short-term needs. We're talking periods from literally overnight up to maybe a few months, sometimes a year. It's truly the liquidity engine of the entire financial system.
Okay, so what are some of the most common types of securities you find trading in this money market?
Well, one big one is commercial paper, or CP. This is essentially short-term unsecured IOUs issued by large corporations. It typically matures in 270 days, about 9 months or less. Because of this short maturity, it's generally exempt from SEC registration requirements. It's usually issued at a discount, like T-bills, and bought by money market funds and other institutional investors. Usually only corporations with very high credit ratings can issue CP easily. Then there are bankers' acceptances, or BAs. These are fascinating instruments primarily used to facilitate international trade. Imagine an American company importing, say, French snails, like in OneSource example. The French exporter might want assurance of payment. A BA can arise from a time draft drawn on a bank based on a letter of credit, where the bank accepts the responsibility to pay the draft at maturity. This acceptance makes it a negotiable instrument backed by the bank's credit as well as the underlying goods. BAs are actively traded and considered very safe. We also see repurchase agreements, often called repos. These are essentially very short-term collateralized loans. A dealer, often in government securities, sells securities, usually T-bills, to an investor and simultaneously agrees to repurchase them back at a slightly higher price, maybe the next day. That difference in price is the interest. A reverse repo is just the other side of the same transaction. Most repos are just overnight deals.
Right. I've heard of repos. What about negotiable certificates of deposit? Are those like the CDs you get at your local bank? And are they jumbo?
Yes and no. Negotiable certificates of deposit, or negotiable CDs, are time deposits issued by banks, carrying fixed interest rates just like the CDs individuals buy. However, these are typically issued in large denominations, usually a minimum of $100,000, which is why they're often called jumbo CDs. And crucially, unlike the CDs most individuals buy, which have penalties for early withdrawal, these negotiable CDs have an active secondary market. That means an investor who holds one can sell it to another investor before it matures if they need the cash. They are considered money market instruments if their maturity is 1 year or less. And importantly, they are FDIC insured up to the standard limit, currently $250,000 per depositor per insured bank. But, and this is a vital distinction highlighted in the sources, you need to be careful not to confuse these with long-term or brokered CDs. These brokered CDs are often sold by brokerage firms, might have maturities from 2 up to 20 years, and are not considered money market securities. They come with additional risks. Potentially limited liquidity if there's no active secondary market, the risk of losing principal if you sell before maturity when interest rates have risen, possible call features allowing the bank to redeem them early, and sometimes, depending on how they're held, even a potential lack of FDIC insurance pass-through. So very different beasts.
Okay, that's a really important distinction. Finally, let's talk about something called federal funds. What exactly are those, and why is the Fed funds rate something you hear about so often as an indicator of where interest rates might be going?
Right. Federal funds, or Fed funds, aren't actually funds from the federal government itself. It's the term for excess reserves that commercial banks deposit at the Federal Reserve, which they then lend to each other, usually just overnight. Banks might need to borrow overnight if they temporarily fall below the reserve levels mandated by the Fed. So it's bank-to-bank overnight lending. The interest rate charged on these extremely short-term overnight loans between banks is called the Fed funds rate. Because it reflects the immediate supply and demand for reserves within the banking system, it fluctuates daily, and it's widely considered a key leading indicator of broader interest rate trends in the economy.
So does the Federal Reserve itself directly set this rate then?
That's a common misconception. The Fed doesn't directly set the Fed funds rate. Instead, the Federal Open Market Committee, FOMC, sets a target range for the Fed funds rate. The Fed then influences the actual market rate, trying to keep it within that target range, primarily through its open market operations, buying or selling government securities to either add or drain reserves from the banking system, thus influencing the supply of funds available for lending. Many other short-term interest rates across the economy tend to move in correlation with the Fed funds rate, and you often hear it mentioned alongside other benchmark short-term rates, like the prime rate, which is theoretically the rate banks charge their most creditworthy corporate customers, or LIBOR, the London Interbank Offered Rate, which historically was a key benchmark for global short-term rates, though it's being phased out. But understanding the Fed funds rate and how the Fed manages it, well, it really offers a critical pulse on the overall health of the banking system, the direction of monetary policy, and the broader economic landscape. It affects borrowing costs for everyone eventually.
Wow. Okay, so we've taken quite a journey, a really fascinating deep dive through this incredibly diverse world of debt instruments. We've covered a lot of ground from, the supreme safety of U.S. Treasuries, moving through the more nuanced backing of agency securities and their unique risks like prepayment, to the tax advantages and local impact of municipal bonds, the varied risk and reward profiles you find in corporate bonds, secured, unsecured, even junk bonds, and finally, landing in the essential short-term liquidity engine that is the money market. So maybe the next time you hear about a major government initiative or a big new corporate venture, you can kind of consider the silent but really powerful force of these debt instruments playing out behind the scenes. Each type, from the absolute safest treasury bill to maybe a speculative income bond, tells a unique story about risk, reward, public finance, corporate strategy, and really the fundamental structure of our economy. So here's a final thought for you to consider. What particular bond or debt instrument that we talked about today after this deep dive intrigues you the most for further exploration, and why?